Hello and welcome to this week's vlog with me, David Jones, and Trading 212. This is for the week commencing the 10th of April. Let's just take a quick look back at what was happening last week. The big event from last week was Friday's US non-farm payrolls. That's the US unemployment figures. These came in a bit worse than expected. The market was expecting around about 180,000 jobs to have been added in the US economy in March. It came in just at 98,000 jobs being added, but the unemployment rate was at the lowest since 2007. So there's a bit of good and bad news. We'll take a look at how the market reacted in a second. But looking ahead to this week, we do have a couple of key bits of data coming out. It's sort of a week for inflation this week, which can have an impact on various foreign exchange markets. So on Tuesday, we've got UK inflation data. Then on Friday, which is a holiday in many parts of the world because it's Good Friday, we've got US inflation data. So we could see some volatility in the foreign exchange markets off the back of that. But probably the biggest thing to watch this week is it's the start of the latest US companies' earnings season. So it's when the big US companies all report how well or how badly the last quarter has been for them. So that starts this week. Probably the big day to keep an eye on is Thursday, when we see various financial companies, including Citigroup and JP Morgan, unveiling their quarterly figures. So we could see quite a bit of volatility for stock markets. Now, in these weekly videos, we always take a look at strategy. What we're going to look at this week is an indicator or an oscillator, the wiggly lines that you can place at the bottom of the price charts. And we're going to start off this week with one of the oldest, and that's the Relative Strength Index, often referred to as the RSI. Now, the RSI is a way of measuring, well, how strong is the market now to how strong it's been recently, or of course, how weak is the market now compared to its recent performance. So for example, something like a 10-day RSI will measure on a percentage basis, is the market stronger or weaker than it's been over the last 10 days. But I think to make sense of this, let's take a look at the theory, first of all, of how the RSI works. We're going to take a look this week at a traditional way of using the RSI. Now, we all know that markets don't move in a straight line. They take a while to get to wherever they're going to. So markets trend up and down. So there's a price chart of a market. What I'm going to do now is just draw in a rough RSI below the market. The RSI has two extremes, traditionally at 70% and at 30%. If the RSI moves above the 70% mark, the market is said to be overbought, like maybe up here, for example. So it's saying the market's moved too far, too fast, and is due a correction. If the market sells off, it's usually going to drag the RSI down with it. And many traders would take the view, if it dips below the 30% mark, that's it, this market is now oversold and is due a bounce back up. So the RSI will usually carve out the same sort of pattern in terms of trends that the market is doing. The one thing to be aware of, and one of the drawbacks of an RSI, because it's not a magic system, if the market starts trending really strongly, the RSI will stay in an extreme for quite a while. So I think it can be quite dangerous just to use an RSI blindly and think, okay, well, because it's overbought here, that's it, I should sell. You do need to take into account things like the overall trend of the market. Is it near any resistance levels? Has it broken through? That sort of thing. So it can give you a guide as to the temperature of the market. Is it getting a little bit overheated? Is it maybe a little bit too pessimistic? But I wouldn't just trade blindly using the RSI. Use it as another confirmation as to where you think the market might be going next. So that's the theory of the RSI. Let's take a look at it on one market. But before we do that, I just want to go through how the US stock markets reacted to Friday's non-farm payrolls release, because it can help give us clues as to how to trade over these announcements in the future. So let's see what the US 30, the Dow Jones, did on Friday when those unemployment numbers came out. What we're looking at here, this is the US 30, so it's the Dow Jones index, and I've zoomed the chart in. We've got 5-minute candles here, so each candle represents 5 minutes worth of trading. And I think it's interesting to see how the market reacted to the payroll figures last Friday. So they come out 1:30 UK time. So just before the announcement, this green candle here, this is the market between 1 and 1:30. And it was trading around about the 20,655 mark. You can see the reaction immediately when that payroll figure came out. It was worse than expected. We saw fewer jobs added in the US economy during March than the market was expecting, and the market sold off. So we sold off really sharply for 5 minutes, edged a bit lower over the next 15 minutes, but as is often the case on these big announcements, the move didn't last. So one strategy could be to look to take the opposite direction to what the initial move is. So if we see a market sell off, let's see if it stabilizes and starts to turn around. Because if we're buying a sell off like this, we have an obvious place to place our stop loss if we think it's going to turn around below the low of the extreme of the sell off. So that's just one idea. It's called fading the initial move, where you get a sharp knee-jerk reaction. Maybe the market's got it wrong. Maybe the move's over-exaggerated, but it can be an opportunity to trade over these big numbers. And you can see the RSI did a pretty good job. We sold off. RSI is down here, oversold. Market rallies over the next hour or so. The RSI down here goes overbought, suggesting the market's hit a peak, and then the market does sell off a little bit before pushing higher for the rest of the session. But it's a way that you might want to consider if you really want to trade over these volatile big news releases. Let's get back to our topic of the RSI. So it's quite good at sort of suggesting when a market has got a little bit too optimistic or a little bit pessimistic. Let's see how those signals fared. Again, we'll stick with the US 30 index. Let's see how they would have done over recent weeks. I've changed the chart now to an hourly candlestick, still with our RSI down here on the bottom. And if you want to bring up these indicators on your chart, it's really straightforward to do. It's done via the top menu up here. Click on indicators and you have a whole different array you can choose from. The RSI is in most popular, relative strength index. I tend to stick to a value of 10 for the RSI, but you can change this to whatever you want. But for me, an RSI of the last 10 hours, last 10 days makes sense. So let's walk back through some of the signals on this hourly chart for the US 30 for the Dow. You can see the last real signal we had, the last really clear signal when it went very overbought was the 5th of April when the market rallied up and eventually did turn around. We did have some very brief signals down here. If I point just here, you can see the RSI value did dip briefly below 30%, suggesting the market should go up, and it did. And again, the same here on the 7th of April. So we have these various oversold and overbought signals that didn't do too badly over recent days because the market was a little bit range bound. But I think this example here, when we had that big sell-off a couple of weeks ago, this does also, I think, illustrate the risks of using an RSI blindly. The market had sold off really sharply. The RSI got dragged into oversold pretty quickly, but the market didn't care. The market kept selling off. So I'd never just follow these signals blindly, but use it in conjunction with support, resistance and trend to try and stack the odds in your favour. For example, the signal back here, where the market sold off in the early hours of the morning, we had an oversold RSI. It did coincide with this old support level from 4 days previously. So we did have a logical place to set our stop loss. Now, one market that was moving last week was the price of gold. Now, gold is often seen as a safe haven destination for investors in times of trouble, political uncertainty, economic uncertainty. And when we saw the US military action last week against Syria, we did see the price of gold surge higher. Gold's an interesting market anyway, so let's just take a look at a more longer term and medium term view for where the price of gold might be heading next. Before we look at the moves in the price of gold last week, let's just take a step back and have a look at the big picture for gold. So I've brought up the gold price here on the Trading 212 platform. We're going back to November 2009 back here. We had that run up out to the highs by the end of 2011. And since then, the story for gold had been one of a market that was continually in decline year on year. But we did see something of a break last year. So let me just draw a trend line on the most recent year's downtrend. And we'll access this from the side menu here. We'll choose trend line. So that trend had really kept the price of gold down from this peak here back in August 2013 to the beginning of last year, 2016. So for a good 2.5 years, we've seen the price of gold stay below this trend line. But last year, we did see the price manage to break out and push to its highest level for a good couple of years. So that was a suggestion that maybe sentiment was changing. The longer term negative sentiment that we've had since 2011 was on the change. Let's take a look at just the last few months. So here's the price of gold going back to November last year to where it was trading last Friday. And we'd seen since December a pretty solid uptrend in the price of gold. Again, let's just put our line on. So we saw the price of gold move its way higher, trading from around about the 1130 area up as high as 1260 by February. And again, the RSI hadn't done too bad a job on the way up of calling short-term peaks, but I think maybe the best RSI signal, this is a 10-day RSI on the price of gold, the best one we've had was when it did sell off from those late February highs back briefly towards the 1200 area. The RSI was oversold and the price of gold moved higher again. Now, with the moves that we've seen over the last couple of weeks, it's maybe not surprising our RSI has pushed back up towards the overbought area, suggesting the price of gold has got maybe a little bit extended. But what's, I think, a key thing to watch for gold in the days ahead is how it reacts if we do see a bit more strength. We had these old highs left from late February, around about the 1265 mark. Last Friday, it did push through that, albeit briefly. It didn't manage to close above it. But many people who use charts will see a break like this as a sign that maybe the price of gold is set to move higher still. So I think in the next few days, let's see how gold reacts. If we get another move back above these highs from Friday, around about the 1270, 1271 mark, many people would take that as a sign that the price of gold is going to move higher still. So I think it's going to be a really key market to watch in the days to come. So that strength last week did see gold push out to its best levels for quite a few months. And as I say, many people would say, well, okay, if we see it move back above those highs, it does suggest that maybe the price of gold is starting to move higher still. But of course, the flip side of that, because there are two sides that make a market, if you thought the price of gold was overextended, you've got the perfect reference point for stop losses if you're looking to sell short above those highs from last week. Either way, I think it's going to be an interesting market to watch in the coming days. That's it for this week from me, David Jones, and Trading 212. Next week, we're going to go back to the RSI when it comes to strategy and look at a slightly different way of using this indicator. To make sure you don't miss any of these videos, make sure you click on subscribe. If you like the video, click on the thumbs up. And as ever, if you'd like us to cover anything in the future, just leave us a message in the comments. But we'll wrap things up there for today, and I hope you have a good trading week.